am Edith Kibler, a fourth-year accounting student from Jacksonville, Florida.
Greetings, I am Tyler German, a fourth-year accounting student from Chicago, Illinois.
And I am Miracle Jefferson, a fourth-year accounting student from Sarasota, Florida.
And I'm Ranch Rutherford, a fourth-year accounting student from Tampa, Florida, and we are
Turn LLC.
is an auditing firm that audits different financial institutions and assesses their risk. C is a financial institution that provides services to more than 6 million customers in over 19 states. LLC will have 48 hours to determine the major risks, discuss the entry-level controls and process-level controls, and finish off with significant deficiencies and material weaknesses.
I'm good.
I'm good. We just have a new task on our hands today. PNC has come to us and they want us to do an audit of their company.
Okay, great. We should get started and I'll check out the background of the company.
Okay, great idea. I'll do some research too so we can just, understand the client.
The initial letter from PNC basically stating what they want from us during this audit. So what were we able to find about the company?
Well, PNC is focused on the fundamentals of growing their customers and their loans and deposit. They also strive to expand and deepen their relationships with their customers.
Mm-hmm. They also have 5 different business segments. Well, let's start off with retail banking. Retail banking, they provide lending services, brokerage, investment management, and cash management services to consumers and small businesses. Asset management group, and they provide personal wealth management for high and ultra-high clients and institutional asset management. Our third one is corporate institutional banking, and they provide lending, treasury, capital market related products and services for mid-sized and large corporations, and government for nonprofit entities.
Another one we have is the residential mortgage banking, which provides investment management, risk management, and advisory services.
Related things that we found with the company was I found 2 disclosures and other stuff that they highlighted in their 10K around their balance sheet. So the 2 disclosures I found were the fair value disclosure, which basically talked about how the company assessed fair value. The other one was other intangible assets and goodwill. They talked about how that it plays a role with their company and how they assess that as well. Two related balance sheet items that we talked about was the total deposits increased from 7.8 million in 2012 to 221 million in 2013, and total loans increased from 9.8 million to 196 million from 2012 to 2013.
Well, based upon these facts, I think we have an interesting task on our hands.
Decided to take on the case. They were able to discuss some business policies and notable accounting facts.
Yes, and the first thing with financial statements we need to talk about is materiality. So materiality, normally here at Turn we talk with a 5% materiality threshold for our accounts. With this being our first time discussing this, PNC being one of our clients, I believe that we should go down to 4% for all accounts. So with the income statement accounts, that will leave us with a materiality threshold of $169 million, with assets being $12 billion, and liabilities and equity being $11 million. As far as the trends from year to year, I believe that we should stick with our normal 10%. So anything above that, we'll definitely assess and note. And also for vertical trends, we'll look at anything that's above 10%. And note it, and also especially the ones that are above 20%, and note those, and figure out why those fluctuations and high values of as far as the vertical side, why they are as such. So definitely note those things, and we'll definitely look at different accounts as well.
The first account that we'll look at is a loan account. We noticed that some of these loan accounts do not have any down payments. This will lead to a possibility of the company not being able to collect on some of these accounts. The bank also has an unrealizable loan structure, which might be a chance that they are accepting loans to people who cannot pay them off, which will increase their assets and their income in the short term. The next account that we have is the deposit account. of course, with any banks, of course, you have deposit. This account is driven by the transactions. There's typically a major fluctuation in this account. We noticed in PNCs that there was a fluctuation of a negative 10.8% from 2012 to 2013. Our loan to deposit ratio was at 89%, which is very high and shows great leverage.
Next, we'll talk about the agreement with Freddie Mac. In December 2013, PNC reached an agreement with Federal Home Loan Mortgage Corporation with Freddie Mac to resolve substantial indemnification and repurchase obligations related to loans that were sold to him between 2000 and 2008. The next account we'll talk about is asset management. Asset management revenue increased 2013 from 14.8 compared to 2012, driven by higher earnings from their BlackRock investment. They also had stronger average equity markets and strong sales, resulting in positive net flows after adjusting to total net flows for clients' activities.
Another account we're going to talk about is the borrowed funds, and the fluctuation between 2012 to 2013 showed a negative 27.12. The decrease in average borrowed funds in 2013 compared to 2012 was due to average commercial papers, to owner average federal time loan bank borrowings, and lastly, owner average federal funds purchased and repurchased. And lastly, the non-interest expense account has a fluctuation of 16.22%. The increase in non-interest expense in 2012 to compare to 2011 also reflected operating expenses for the RBC Bank acquisition, higher personal expenses, higher settlements for other litigation, and increased expenses for other real estate owned.
Okay, guys. Now that we've looked at the understanding of the company, we looked at some of the financial statements and what we'll be looking at in depth. We set our materiality threshold and all that good stuff. I think we need to assess the risk around these accounts and this company. So first off, I looked at the assertions for the company, and basically we rated high, moderate, or low, going off of the company and whether or not that assertion related to that account will be of use, or how much of use it will be. So one of the accounts we looked at was loans, and with loans, we rated a high rating for loans with that assertion of existence, because with the bank they do a lot of loans. It's a very high account as far as the money that's in the account, and it's a constant revenue source for the bank. So that's why we rated a high assertion for that.
Materiality has a 4% material threshold, which we talked about earlier. Transaction volume was determined from PNC 10K, which shows a breakdown of all the transactions. Prior period adjustments was determined by the prior period adjustments on the 10K documents located on their company's website. Other risks: accessibility of fraud, accounting complexity, judgment and estimates, level of automations, system complexity, standardization, and control environment were all assessed based off our research. the industry, and our professional judgment. Looking at total deposits, we rated material risk high because of the balance in the total deposit account. Transaction volume is rated high for total deposits because banks incur a lot of deposit transactions throughout the day.
Now we're going to talk about the inherent risk section. The inherent risk was done for each assertion to be determined whether or not that the attribute risk will have an effect on that particular assertion, and we have rated it as such. With the asset management being one of the biggest line item for non-interest income, we want to ensure that they are actually accounting for these revenues at the correct fair value and the correct amount. We identified 5 controls that were related to this account, which are ELC 03, ELC 04, ELC 05, ELC 08, and ELC 14. These controls are generally focused around monitoring and financial reporting.
So, after testing the controls, we had to make sure that they were effective. So, we're looking at the residual risk, and one of the accounts that we looked at was residential mortgage. After putting in the certain controls for residential mortgage, we were able to lower the completeness, valuation, and presentation of this account. But PNC should make sure that they monitor their existence and obligations for these accounts, for making sure that all transactions exist and that the obligations are at the correct amount for each entity.
Okay, now we're going to talk about process level controls. So we put in these process level controls for any residual risk that still remains. So if we had a higher moderate risk level in the residual risk, then we decided to put in process level controls to lower that to a risk that we felt would be okay for us to look at these accounts. So looking at the borrowed funds account, we saw that the risks were low when it came to residual risk, so we did not put in any process level controls for that account. And then looking at one of the non-interest expense accounts on the marketing expense, we saw that they had a moderate risk level associated with the valuation and the obligation assertions. This was due to ELC 04 and 09 failing. Therefore, we decided to put in process level control AP03. We put that control into place because it was a reconciliation, and we felt as though it could lower the obligation as well as the valuation assertions that were moderate level, bringing it down to a low level. Okay, now we need to look at deficiencies that we found throughout the term of the audit. The first one I found was related around terminated key executives whose employment options included non-compete clauses that would be effective under certain circumstances. So with this deficiency, we saw that it was immaterial in nature. We also saw that certain accounts related to it, and basically were all asset accounts. Some of the assertions that were related were completeness, accuracy, and valuation. And some of the disclosures that we found related to were the fair value disclosure that we mentioned earlier, and as well as the loans and commitments to extend the disclosure. Overall, we saw that this was not identified by anyone, but we believe that this deficiency should have been identified by the payroll group. We noted that this was a significant deficiency for PNC Bank.
Moving on to the next deficiency, the company failed to consider the specific terms of the issuer's various partnering relationships, and if the relationships affected the company's recognition of the revenue and from its partnering relationships. We noted that this deficiency was a material deficiency, and the related accounts are all assets. The related assertions are completeness. The other related assertion is accuracy and valuation. And the disclosures that was related to this deficiency is fair value and loans and commitments to extend. The information that was provided didn't provide us with anybody that identified the deficiency, but however, the deficiency should have been identified by the controllership team. We found a control that compensated the deficiency, which is REO1, and we also found out that it was a significant deficiency.
Another deficiency, the company failed to perform applications testing to confirm all implemented applications controls are in compliance with FDIC. We noted that it was a material deficiency and the related accounts were all liability accounts. The related assertions are completeness, obligation, and presentation, and there were no disclosures related. There was no compensating controls, so we noted this deficiency as a material weakness. Government regulators identified this deficiency by requesting evidence of FDIC compliance, which the company was unable to provide.
Another deficiency that we found was that the company has an inadequate practice for some of their recognition and assessment of certain banking attributes, activities, my fault, whether on and off the balance sheet. We noted as an immaterial deficiency account that were related to the revenues, gains and losses, and the liabilities. The assertions that were related to these certain accounts was our completeness, existence, valuation, and rights and obligations. Okay. No one identified these problems, but we feel that it should have been identified by the controllership team. Okay. Based upon the information noted above, we noted this as a significant deficiency.
So in this episode, we assessed PNC Bank. We looked at their financial statements. We got an understanding of the company. We looked at their disclosures that were found significant. That we found significant to the company. We assessed the risk related to potential misstatements and control failures. Well, we test some controls, some basic level controls, and then we put in some more process level controls that we felt were needed if the residual risk was still there, whether it was high or moderate. Then we looked at some deficiencies, and we saw if there was any compensating controls already in place, and we assessed those as significant deficiencies, regular deficiencies, or material weaknesses. And so overall, we saw that PNC was very stable, but there was some different things that we felt that the company can improve on.
Our first suggestion that we recommend that they put in place is that they require initial down payment for loans.
A second suggestion that PNC can take in is having internal testing to confirm applications, controls that are in compliance with the FDIC.
A third suggestion for PNC is to monitor and have policies for new acquisitions.
And the last and probably the most important one is to continue to use Term LLC as their external auditor. And we are
Term LLC.